Debt financing and equity financing are the most common methods by which companies raise capital from the general public. Every company needs capital for either growth or to fund its working capital requirements such as raw material cost, workers' salary, factory rent and other expenses. In this video, I will tell you what debt and equity financing are and how they are different. Hi everyone, I am Prarthana from Clear. We are India's largest tax and financial services platform where we have served more than 6 million tax filers so far. Subscribe to our channel to get investing tips and learn more about growing your money. Debt financing involves corporations selling bonds, debentures, bills and notes to lenders to raise funds. By making a loan with a predetermined interest rate and term, the lenders become the company's creditors. The corporation commits to return the loan and pay the interest on time in exchange. Debt financing, unlike equity financing, is a loan that must be paid back to the lenders. Even if a corporation goes bankrupt, creditors are paid first, followed by equity stockholders. Corporations sell a piece of their stock or ownership to the general public through equity financing to raise funds. Equity financing is a means of raising funds without adding to a company's debt or financial obligations. The number of equity shareholders grows due to the equity financing, while the owner's interest in the company decreases. The corporation does not need to repay the capital because the equity shareholders are the company's owners. Furthermore, the owner is not the sole decision maker because equity owners have the opportunity to vote on significant firm decisions. Now, did the definitions make sense so far? If it did, write clear in the comment section below. Moving on, now let's assume Mr. Kohli, the owner of XYZ Limited, wants 10 crore to start a new project. Mr. Dhoni, an investor, is willing to give him rupees 10 crore. Mr. Kohli now has two options. Firstly, debt financing. He can take a loan from Dhoni for rupees 10 crore, pay a monthly interest rate and repay the loan on time after a specific period. Or equity financing, where he can sell 10% of his ownership in the company to Dhoni and get the capital without worrying about the repayment. By selecting debt financing, Kohli can retain 100% of the control in the company but will have the burden of the loan and interest repayment. He will also be spending a big chunk of his profits to pay the interest on the loan. On the contrary, by selecting equity financing, he will get rupees 10 crore without any repayment burden, but he will have to involve Dhoni in all the future decisions. So, let's look at the difference between debt financing and equity financing.
Firstly, with debt finance, you are required to repay the money plus interest over a set period, typically in monthly installments. On the other hand, equity finance carries no repayment obligation, so more money can be channeled into growing your business. Investors do, of course, want to make a return on their investment, but this only happens if and when your company does well. Therefore, unlike debt finance, which has a predetermined cost, the cost of equity finance is more variable as it's a share in your company's future earnings and value. Secondly, ownership. Equity investors buy a stake in your business, meaning that your shareholding decreases, whereas you retain full ownership with debt finance. However, it can be worth having a reduced percentage of the business if the equity investor provides a lot of value in the form of both money and non-financial resources, such as expert guidance and access to contacts that help you create a larger, more successful company. Thirdly, security. A lender may ask the borrower to pledge an asset as security for the loan, such as a property or equipment. If the borrower can't repay the loan, the lender may claim the asset to get their money back. However, with equity finance, you don't need to put up the collateral. Fourthly, access to finance. If you are a startup with no trading history or physical assets and don't want to use personal security, you might find it difficult to secure debt finance, at least from the traditional lenders. Equity investors are often willing to back companies that are considered too high risk by many debt finance providers. Fifth, involvement. An equity investor might ask for a board seat. That means they'll have to put an input into the overall direction of the business and be involved in company's decisions. The right investor will bring valuable experience and expertise to the boardroom and will be able to open doors for you with their network of contacts. By contrast, a lender has no ownership and no involvement in business decisions. Sixth, fundraising process. If you are in a hurry to raise cash for your business, then equity financing probably isn't your best option. It can take a considerable amount of time to find the right investor, and then you have to negotiate the terms of the deals and facilitate the due diligence process, among other things. There's also a lot more legal work involved. Debt finance is usually more straightforward, and you can often receive the funds in a matter of few weeks or even days from some providers.
Ultimately, the financing method you choose will depend on your situation, including the nature of your business and its stage of development.
Debt finance might be the best option for you if you have consistent cash flow and a proven business model. You would prefer to remain the sole owner of your business. You would like a short-term relationship that ends once the loan is repaid, and it is easier for you to manage cash flow and forecast expenses if you know in advance how much principal and interest you need to pay. Equity finance could be the best option if you have a limited financial history or lack of collateral. You don't want the burden of regular loan repayments. You have plans for growth, such as moving into new markets or expanding operations that require a lot of capital, and you would benefit from the skills and experience that an investor could bring.
So folks, I hope you understood the difference between debt financing and equity financing. You can start your investment journey by downloading the Black app by ClearTax from the link given in the description box below. Well, download the Black app as it will help you grow your wealth and invest wisely. Also, don't forget to subscribe to our channel for more finance related content. See you soon in the next video. Goodbye.